So we're going to go over 5 names that I think are pretty interesting here. And if you're new to the channel, welcome into Compounding Capital. My name is Colton. We work on a fundamental analysis on this channel, and we're knocking on the door of 5,000 subscribers as of right now. So please consider subscribing and smash that thumbs up. Let's get over the line. And in today's video, feel free to leave a comment on stocks that you're finding interesting or that you think are on sale. I was writing cash secured puts at $30.50. The stock closed at $30.25, so I did get filled, but I did also collect about 2.5% premium. So overall, I'm not mad about the position, but I'm going to downsize it as market opens tomorrow, and hopefully the market opens a little green tomorrow, because this one has been a falling knife and it's a dangerous one, more of a speculation play, but I do think there's some pretty good upside here. That stock is going to be ticker symbol CELH, Celsius. Celsius develops, markets, and distributes functional energy drinks. Very, very popular drink, but the problem is with drinks, they really don't have moats. And so it takes time to build those moats. It takes time to show that it's not just a fad, but it's a long-term name brand that people are going to know, trust, and go to. Because of the big brands that are already out there of Pepsi, Coca-Cola, and Keurig Dr. Pepper, this one is kind of in a niche area with focusing on functional beverages, and has a great partnership with Pepsi. Now, this one was trading for $95 a share. Couldn't really make sense of these valuations, and now is down to $30.25. Actually, the 52-week low is at $29.65, which it recently hit, and you guys can see here that it's just done nothing but go down in a straight line, and that's what we call a falling knife. It really becomes hard on a technical basis to figure out where is this thing finally going to stop. So you guys can see here that right around $29.28 is where I started finding the stock interesting, and writing those puts actually put me at a break even, I think around $29.75. So even though I filled at $30.50 with the premiums deducted, it was a break even of $29.75, I believe. Now, Schwab has this as a very poor rating, an F. Now, Morningstar has this as a 3-star rating and with an economic moat of none at this point in time. And that's kind of the fear. You're talking about a growth stock that is a smaller cap company in a very competitive market, and not having an economic moat is pretty concerning. But the thing I want to point out is they did give it a 3-star rating, and that was when the stock was trading around $40 a share. Fast forward to today, you can basically get in the stock around $29 to $30 a share, and they have a fair value sitting at $36. I imagine that they're going to upgrade their analysis here to make it a possible 4-star rating at this point in time. When we look at where experts see the stock price, they see it anywhere between $26 to $99. And so I do think it's a little de-risked here in the $20 range and maybe the low 30s. But what I want to point out is the tremendous growth that this company has had. They're projected to do anywhere between $1.20 to $1.50 next year, which means that's probably trading around 25 to 20 times earnings. And for a company growing around 20%, this puts it pretty much in a PEG ratio sitting around 1 times, which is pretty interesting for a smaller cap company that has rapid growth and has the ability to actually outgrow what most people think. There's not a tremendous amount of coverage on this company, but it is a very popular company. So I keep my price analysis around $28, $29 a share, and I used options to kind of average in around $29.75. Now, just a quick glance at the chart, you guys can see here that it is definitely been a pretty ugly story here. And I believe the next line of support for this company is going to be sitting right around $28.10 to right around $28.15. I'm hoping that we are finding a bottom here, a possible double bottom with this 5, 6, 7, 8, 9 count. And so we did get a 9 count with a buy signal here. So I'm hoping that we're oversold and we're going to start finding possibly a bottom in this stock. This is one that I would probably cut my losses on very quick. So this is one that is a high risk, high reward, but it's also very interesting at these levels. In today's market, it's hard to find a company trading at a forward PE sitting around 20-25 times earnings that has the capabilities of growing over 20% and is getting over 18% return on invested capital. There's a lot of things to like about this company. The moat is not one of them, but the return on invested capital, the return on equity, and return on assets are some things to really like about this company. The other thing is it does have some decent fundamentals when we look at a smaller cap company that's kind of speculative. Cash and cash equivalents on this company sitting at $900 million, and they only have $1.7 million in debt. Very clean balance sheet. Once again, a lot of things I like about this one. The moat is just not one of them, which makes this one a little bit higher risk, higher reward. but I do think the fundamentals are pretty strong there, and they have the capabilities with the cash on the balance sheet and how well they deploy capital to really outperform markets. If we look over the last 5 years, gold has been on a nice upward trajectory here, and especially over the last year where the majority of those gains have come in. Gold is up 46.5% in 1 year. This is outrageous. And it seems like these elevated levels are not only going to stay there, but gold could still climb past 3,000 by most experts, which is now going to lead us to our next stock. Ticker symbol GOLD. Now this is dealing with commodities, which commodities are fairly risky, but when you're talking about an asset that you're digging for that has shot up 77% over the last 5 years, but your stock is only up around 16%, there could be a catch-up trade here, and I really do like Barrick Gold. I would be buying it on a pullback to $18. If you guys missed my videos on Barrick Gold, I'll leave it above. I did buy the stock around $14 and sold it around $18, looking to possibly get back in around $15 and $16. Unfortunately, those levels really never came up, as you guys can see here over the last year. The stock is up 42%, and it looks like it wants to just go to new highs, much like gold, the underlying asset, does. Now, as of right now, the forward PE is sitting around 10 times earnings, does pay nearly a 2% dividend, and it has a strong buy rating with a $22 price target. But here's what I want you to think about. Oil prices have been pretty stabilized over the last few months, which means that their input costs are probably pretty reasonable at these levels. And then you take the price of gold skyrocketing. This is going to lead to strong free cash flows when it comes down to 2025 and 2026. When we look at Schwab, they put them in the 46th percentile, which is basically a market perform at these levels. They're not really seeing a tremendous amount of upside, but they're also saying that it seems like a quality company. Morningstar is rating it a 3-star rating with an economic moat that's non-existent, very competitive field, a lot of input cost, margins can be a problem. This valuation when the stock was trading around $20 a share. And they believe that fair value is probably sitting closer to $22 a share, which I think is pretty reasonable. And that's why I think this is probably closer to a buy around $17, $18. So if we see a cool down in the commodity of gold and we see a spike in oil, we could actually see something like Barrick Gold really take a pretty substantial hit. I'm talking about a 10, 11% intraday hit, which would actually put it in a buy zone for me personally when I think more longer term. And the fact that I believe gold prices are going to remain elevated. Once again, I'm going to call Barrick Gold a medium risk with a decent reward. So I think it's pretty fairly priced. I think the risk versus reward definitely gets a little bit more interesting below 17. Now I'm waiting for another pullback on this one, as I did buy it around $27 a share and it shot up to 33 bucks. I sold it. It kept going up to $40 a share. And here we are again, sitting right around 33 bucks a share. It seems to find the support around 27 to 30 bucks a share, and it rebounds pretty well off of these levels. We can see that it hit as high as $50 a share. And what stock am I talking about here? OpenText Corporation, ticker symbol OTEX. It's appealing because it pays a 3% dividend. It's trading at 9 times earnings, and this is a small cap AI play. They offer business cloud, business AI, and business technology, making businesses run more efficiently and relying on AI and technology capabilities. Now, even though we've seen the price kind of go all over the place, the one thing I want to point out is the steady growth that the company has had. This was doing $3.1 billion in revenue and steadily growing, and then saw an explosion as of 2023 of 20% growth rates. And I think these 20% growth rates could actually go into the future, but the thing is, it's only trading at 9 times earnings. The other thing I like about OpenText, it has been acquiring cybersecurity companies as of late. They acquired one in 2019, 2021, and Pillar in 2024. Multiple reasons why I think this is a very, very interesting company at a very reasonable price. I think this is a screaming buy around $25 to $27 a share. That's where my analysis takes me, and that's using very, very soft growth rates. So before I get too bullish on this company, let's talk about the negatives. They're not really doing a great job of deploying capital here, only getting a 5% return on invested capital. Nothing impressive there. And when we look at return on equity and return on assets, once again, this is kind of where we would like to see them pick up the pace. Good free cash flow margins, good, decent profit margins, and very strong gross margins. So overall, I think the margins are pretty strong in this business. Would like to see those profit margins actually expand, but with the amount of money that they've been making for acquisitions, I do think this will be coming pretty soon. So not only do I think this is a company that's trading at 9 times earnings, that's pretty cheap, but I think they can grow profit margins, and I actually think a lot of their investments on the cybersecurity could pay off as well, which means that return on invested capital is probably going to go into the double digits, if so. So let's talk about some other reasons why I like this company. Not a lot of coverage here. Schwab doesn't have any coverage. Morningstar doesn't have any coverage. CFRA has no coverage. and Argus has no coverage. This is kind of a company getting overlooked, and that could be why the multiple is so depressed. Now, Market Edge does have a long view on this. When we look at forecasts, we have as low as $33 a share and as high as $53 a share. You guys can see the revenue hit that they're going to be taking in 2025, which is why we've seen the price collapse. But we see that earnings are actually going to come in pretty strong, around $3.60, and possibly doing close to $4 of earnings in 2026. Now, I honestly don't even want to go that high on these expectations, but I do think this is a company that's going to grow probably between 4 to 5%, and we're going to see exponential earnings growth as those profit margins expand. I don't know if they're going to earn around $4 a share, but even if they earn $3 next year, that puts it at a forward PE of around 11 times. With a company that is acquiring other companies, is still growing. When I look at all of this, the risk versus reward on this one with that dividend yield is pretty nice. I would say that the risk is pretty low at these levels. Ideally, you'd like to get it between $27 and $28. Stock number 4, I'm just going to say it once. It's Pfizer, guys. You know what's coming. $27 to $28. This stock is a buy, in my opinion. I think we saw earnings trough here. We have a low of $29 and a high of $45, getting nearly a 6% dividend. This company really doesn't need to do much to actually have an outsized gain here. If they show any sort of revenue growth and any sort of earnings growth, we could be looking at a $35, $40 stock within the next 18 months. So I do think that the risk versus reward is very, very appealing on this one. Maybe it gets back down to $24, $25 a share, which is about a 15, 16% downside risk. But I think the upside opportunity is pushing nearly 50% on top of a 6% dividend yield. Now, when we look at Schwab, they give it a C rating, putting it in a 32 percentile, basically a market perform. And then Morningstar has it as a 4-star rating. Most other companies have it as a hold. Now, when Morningstar did this analysis, it was at nearly $29 a share. Currently, the stock's trading around $28.50, and they believe that fair value is sitting around $42 a share. So a couple knocks on Pfizer here. Once again, return on invested capital is very, very bleak. These are things we don't want to see. This is why the company is trading at 10 times earnings, along with revenue and free cash flow absolutely collapsing here. But very much like the commodity trade of gold, these biotech companies are going to go through ebbs and flows, ups and downs. So what you do is you try to accumulate quality biotech companies on big, substantial dips when you think valuation makes sense, and you sell them on the rips. Now, unless if they have multiple things in the pipeline that look promising, they're forever holds, but these are technically almost trades like commodities. Now with Pfizer, this is one I would probably hold because of what's in their pipeline at this point in time. I really think they're going to be an oncology player, and I think they're going to be one of the most important players when it comes down to cancer remedies. Now, this is a company that's carrying a substantial amount of debt. They have $7 billion in cash and $69 billion in debt, which gives it a net cash of negative $62 billion. But before we get freaked out about that much debt, the thing I do want to point out is this is a company that historically can free cash flow between $10 to $15 billion. This balance sheet doesn't really bother me that much. On top of that, they recently made a move. They cut their stake on the Sensodyne maker of selling shares to the tune of $3.3 billion, which is definitely going to help that cash and balance sheet. And so I do think we might have seen the lows in Pfizer around $24, $25. So I don't think there's a tremendous amount of risk in this one. Sitting around $27 to $28 is where I think it makes sense. So could we see a sell-off in Pfizer? So when I look at this right shoulder that's formulating where we could have a breakdown in the stock, there's a couple things that make me still optimistic that it might not sell off. When we zoom in on the 2-hour chart, it is forming this double bottom here in an area of support that I have drawn literally to the penny. So when I look at the shorter term charts, they do look like they're turning to more of a positive configuration and could actually break out of this possible head and shoulders pattern. MACD is actually pointing up and crossed over. RSI and money flow is pointing up. The McClellan oscillator is flatlining while the stochastic is pointing up. So to me, it looks like we could have a reversal starting on the shorter term charts. And if that starts turning along on the longer term charts, this could actually break back above to $30 a share, which is going to lead us to our next company. It's up 36% over the last 5 years, hit a high of $76 and now is at $26 a share. You know it's probably going to be another commodity company, and that's going to be Mosaic. 52-week low is $24, 52-week high is $38. This does pay a 3% dividend as well. Now, I want to make it clear, with the recent hurricane in Florida hitting, there is going to be some disappointment, I believe, with their earnings. The other thing is China's been soft lately, and that has slowed down growth for them as well. Because of the hurricane and because of China's recent slowdown, I do think earnings can disappoint for Mosaic. With that said, I do believe that this would be a long-term buying opportunity for this company. I have an ideal stock price sitting around $24, $25 a share. And as you guys saw by the charts, it did hit those levels. So I would be interested in adding into these prices. But once again, I would probably wait for earnings. I will update Mosaic on the next earnings call. Schwab is giving it a 24 percentile, a market outperform. Morningstar is also giving it a 4-star rating. Economic moat non-existent. It's just a very competitive market. I do think there is somewhat of a moat here though. Being one of the largest producers of fertilizer, I tend to think that they have a little bit more of a moat than they're getting credit for. Now, when they did this analysis, the stock was trading around $26 a share, and they had an ideal stock price around $40 a share. I think below 25 bucks a share, this one is very interesting. But once again, I would wait until we see what happens with earnings, but that could lend the biggest opportunity we've seen with Mosaic. As always, ladies and gentlemen, hopefully you enjoyed. Leave a comment down below on any stocks you're finding interesting, and we will see you in the next one.